So let's talk about gross income. This is the most important aspect of taxation or income tax. Because you do remember that in Zimbabwe, the main taxes are income tax, value-added tax, capital gains tax, withholding tax, and those other small taxes. So the main tax there is income tax. Income tax, we are talking about taxation of individuals on their employment income. We are talking about partnership income. We are talking about taxation of corporates on their trade and investment income. We are talking about mining. We are talking about farming. We are talking about deceased estates and so forth. So if you see that throughout this tax head, the income tax head, the gross income, the starting point is gross income, because the name to say income tax head comes from this gross income. So you need to understand and to pay very particular attention to this topic, gross income. So we are going to cover 72 pages. So we are going to be cruising. Okay. So this gross income is defined, or this is just a basic framework of calculating your gross income. You're going to say the total receipts that we have received, whether they are capital, whether they are exempt, you're just going to add them. Then, of course, you're going to deduct the capital receipts because those ones are excluded from the definition of gross income. Then you're going to remove also whether revenue or capital receipts that are received from a place that is outside Zimbabwe, because we know that Zimbabwe is source-based. Our tax system is source-based. So income that is proved to the satisfaction of the commissioner that they are not from a source within Zimbabwe cannot be taxed in Zimbabwe unless if they are deemed to be from a source within Zimbabwe. Then you are also going to deduct accruals and receipts that fall due before the commencement or the end of the year. Yes. So if you receive income that belongs to next year, then we should exclude them because it doesn't belong to this year. Then after deducting those three, you have your gross income. So what is gross income? Gross income is defined by Section 8 of the Income Tax Act as the total amount received by or accrued to or in favor of a person, or deemed to have been received by or accrued to or in favor of a person in any year of assessment from a source within or deemed to be within Zimbabwe, excluding receipts of capital in nature. So we are going to cover all those bullets, 1, 2, 3, 4, 5, 6, 7 bullets. You have to define what we mean by total amount, what we mean by received by, and so forth. What we mean by a receipt of capital nature. This is very important, so we need to go one by one. So realize that of these 7 bullets, only one bullet, that is the first one, the total amount, is defined to say what is total amount is defined in the Income Tax Act, that is paragraph 2. But all the other bullets, to say received by or accrued to, these are not defined in the Income Tax Act, but rather they are governed by case laws. So let's go to total amount. Total amounts, it means all receipts and accruals, whether deemed or actual, whether monetary or non-monetary, include property, corporeal or incorporeal, as long as the property has an ascertainable monetary value, e.g. shares or car in lieu of payment for work done. So by amount, you are basically saying we are just talking about all receipts. Whether you actually received money, or it's not really money, but you received maybe an asset. The employer one day say, we don't have the cash to pay you, but rather we are able to give you this asset, this share that is worth $100, or this desk that is worth $200, or this car that is worth $5,000, instead of actually paying you cash. Someone is going to tax you on that asset that you would have received, as long as that asset can be expressed in monetary terms. So that's what we mean by total amount. And another important aspect is we tax an amount on the area of receipt or accrual, whichever happens first. And this was decided in the Magaya versus Commissioner of Taxes. That was about total amount. Let's go about received by. This is one of the important bullet in the definition of gross income, because we do have a lot of variations there. So let's talk about received by. An amount is only taxed when it has been received or accrued to a taxpayer, whichever happens first. Received and accrued are not defined in the Act, but in the case law. That's what I was saying in the previous slide, to say total amount is the only bullet that is defined in the Act. The other ones we use case law. So what do we mean by received by? It means received by the taxpayer on his own behalf and or by someone for the taxpayer's benefit. So this is a very important statement to say. If we can say, if the commissioner is to say you have received an amount, it has to be proven that I would have received that amount for my behalf, or it has been received by someone for my own benefit. Yes, so take, for instance, if you receive your salary, yes, you're going to use your salary whatever you want. Even if you reinvest your salary, you would have received your salary on your behalf and for own benefit. But let's say you receive a loan, you would have to repay the loan to the bank or to employer. So you cannot be said to have received the loan because you have to repay it. So you have not received it for your own benefit. Therefore, if you receive a loan in Zimra's eyes, you have not received anything. And also another example, if an estate agent receives an amount, let's say it's an estate agent that is managing your property, the rent that the estate agent received from the property, they are not received per income tax definition. They are not received because the agent is going to transfer those funds to you. So Zimra cannot tax the agent, but rather it will tax you. So in this case, the rent also would have been received by the agent for your own benefit. So Zimra will tax you instead of the agent. The estate agent is only taxed on the commission he charges for collecting the rent on behalf of the landlord. Of course, the estate agent will be doing business, so he will charge you a commission. So that commission will be received by him, and therefore it will be taxable in a sense, not the actual rent. Okay. Let's talk about accrued to. It means due and payable or entitled to. So if an amount is now due and payable to you, let's say you have to receive your salary on the 30th, and now it is 30th. It means that your salary is now due and payable. So Zimura is actually going to come and tax you because the amount is accrued to you. So generally we say income accrues when a taxpayer becomes entitled to it, and this was decided in the case of Nitt-Gritt versus CR in 1926. What does it mean to say the amount is you have become entitled to the amount? It means you have obtained an unconditional right to receive the income. You have to receive your salary because you have been working for the whole month, and it is now 30. So you are entitled unconditionally. It means that you can actually initiate a legal action if you do not receive that salary. So in that case, we say you have an unconditional right to receive the salary. So we say the right must be supported by legal agreement, contestable in a competent court. So in this case, it would be like your employment agreement, your employment contract, where it will be explicit to say we receive salary on the 30th. Okay. But before including any receipt in gross income, establish the date of accrual. Once this date is established, check on whether or not it falls within the tax year you are assessing. E.g., director's fees accrue when voted, while leave pay accrues proportionally on the last day of each month during the leave period. Okay, so this is an important case in this accrued to definition. So the complainant, let's not talk about this case laws. You can search litigant case and go through it to see what happened there. But this is just a structure of a case law to say there should be a complainant or the party that is aggrieved, and there should be a respondent. So if we say litigant versus CIR, we are saying litigant was the complainant, and he was complaining against the Commissioner of Inland Revenue. If we say court, we mean the Commissioner of Taxes, and that will be a Zimbabwean case. Okay, let's talk about a person. This is also, there's another thing that's defined actually in the Act. If you go to paragraph 2, with the definitions, you actually see the person is also defined. And it means a natural person or a heuristic person, that is both corporate or unincorporated. It can be deceased estate, it can be an insolvent estate, it can be an association of persons, it can be a local authority or like authority, a company, a trust. But it should exclude a partnership. For the purpose of this definition, a partnership is not a person. You should always remember that when we do partnership income, this should come again into your mind. A partnership is not a person. So when we say a person in taxation, we are not really referring to a natural person. Yes, it can refer to a natural person when we are talking about employment income or taxation of individuals, but it also refers to heuristic persons like a company, deceased estate, an association of persons, and so forth. So that is a person. Let's go to year of assessment. Year of assessment, we have an ordinary year from 1 January to 31 December. But let's say if a company has got a 30 June year end, it can apply for a substituted year of assessment. So there are two types of year of assessments. There is an ordinary assessment, which run from 1 January to 31 December. Then if a company has a different financial year, then it can apply for a substituted year of assessment, which can take any form. It can be from June to June, it can be from July to July, it can be February to February, and so forth. Okay. You heard us talking about, we said gross income, a total amount received by accrued to when of a person, or deemed to have been received by or accrued to one of a person. So we want to discuss what we mean by deemed, and this is governed by Section 10. Section 10 talks about deemed accruals. Then also Section 12 talks about deemed source, because we say income is taxed from if it is from a source within Zimbabwe. So sometimes you might see actually that this particular income, like foreign dividends, is not really from a source within Zimbabwe, but then Zimbabwe actually deemed that income to be from a source within Zimbabwe. Or you can actually see that this is not really income that is accrued to me, but Zimmer deems the accrual to have accrued to you. So what do we mean by deemed? It means taken to be or considered to be or assumed to be. So normally if you do something, it's not actually what is happening, but it's assumed that that's what is happening. So if your salary is garnished to pay your debt, it is still gross income in your hands. Let's say you had a loan with your employer, and at year end or your bonus, the employer just take everything because the loan is now past you. The employer is going to tax you even if you have received nothing. So it is deemed to have accrued to you, even if you really didn't receive anything in respect of that income or that salary. Okay, let's talk about source. Income is not taxable in Zimbabwe unless it is from a Zimbabwean source. We talked about this in the previous slides. Or we can tax it if it is deemed to be from a source within Zimbabwe. However, the term source is not defined in the Act, but rather we rely on case laws. So in the Rhodesia Metals versus Commission of Taxes, that is Zimbabwe, source was defined as not a legal concept, but something an ordinary man would regard as the originating cause of the income. So take note of the originating cause. If we want to determine the source of income, we look at the originating cause of that income. Okay. So if we are to determine the source of income, we consider three things. What a taxpayer has done to earn the income. That is, what is the originating cause of this income? Number two, where the action occurred. Is it in Zimbabwe? And number three, if the action occurred outside Zimbabwe, is the taxpayer action deemed to have accrued in Zimbabwe? So those are the three questions that we are going to ask us if we are to determine the source of income. So in the Rhodesian Metals versus Commission of Tax case, it was concerned the source of the profit made on the sale by the company of its principal asset, that is mining claims in Zimbabwe. The company was registered and resident in England, where it had its board of directors. It was held that the source of profit was Zimbabwe. Why? Because regard was made to the fact that the sole business operations of the company had been the purchase of property in Zimbabwe. The claim had been acquired and developed in Zimbabwe. So the source of that amount that was received on the self-mining claims was Zimbabwe. Let's talk about employment income. What is the source of employment income? Let's say I'm here and I'm employed by ABSA, South Africa. I'm working virtually. I'm actually working from Bulawayo, Zimbabwe, but I'm employed by ABSA, South Africa. And I'm receiving salary from ABSA, maybe 100,000 rands. Is Zimbabwe going to tax me? Is that 100,000 from a source within Zimbabwe? So that's what we are going to be covering from now on. So we said the source of income, we really look at the originating cause of that income. And if you look at employment, the originating cause of the employment income, of course, is the rendering of the services. The sources, that's where the services were rendered. So in this case, I'm renting the services in Zimbabwe, in Bulawayo. So that's the source of the income. So regardless of where contract was made or the payments made, if where I am performing the services in Zimbabwe, then it is taxed in Zimbabwe. Let's talk about source of common dividends. The original cause are the shares, of course, and it is where the share register is kept according to Boyd versus CIR. The country in which the company paying the dividends is incorporated or the registered office of the company, that's normally where the share register is kept, isn't. The branch register is deemed to be part of the principal register, according to Lem versus CIR. Okay. Then sources of directors' fees. The originating cause is the directorship exhibited at the company's AGM. So normally where we conduct the AGM, that's where the originating cause of the directors as fees. So the sources where the head office of the company is located, where the AGM is held, according to the ITC case 235. It is only there that he can make his voice as director head. So that's the source of his income. What about the source of royalties, like patents, copyrights, and like assets? It is where the wit, labor, and intellect were exercised. This one is referred to the case of Millen versus Seara, 1928. What about natural resources, where the property is situated, e.g. a mine? So this was the case. What about the source of interest from a loan? Work done by the lender in giving of credit is the originating cause. That is, the provision of loan is the originating cause of the interest being received. That source is where the credit was provided, where the lender provided the loan services. And this was the case of Ciara versus Lever Bros and Unilever and William Dam and Curl. What about the source of annuity? Of course, the originating cause of an annuity is the testament or the document, the contract giving rise to that will. If the annuity is from a purchase, the originating cause becomes the contract. Sources where the act or document giving rise to the annuity was created or where the fund is located. For rent, of course, it will be the place where they move property situated. If it is situated outside Zimbabwe, then the source is outside Zimbabwe. That means if you have your asset in South Africa and you are earning rentals from that asset, and that asset is actually immovable property, then you cannot be taxed in Zimbabwe because the source of that rent is South Africa, where the property is situated. Rent from movable property. We have two types of sources there, where the lease is actually short term, that is less than 5 years. The originating cause is where the lessor conducts his business, and where it is more than 5 years is where the lessee uses the asset. Let's say I rent a motor car, I go to DRC. If that rental is below 5 years, then the originating cause is Zimbabwe. But if I rent a car, go to DRC for 10 years, then the originating cause of the rentals is DRC, not Zimbabwe. You need to take note of this one, it's examinable. What about income from business operations? Is where the business is conducted, where the operations extended outside Zimbabwe. The source depends on the facts of the case, and it was decided in this case law. Okay. Then let's talk about deemed accruals. Is governed by Section 10. We've deemed accrual on reinvestments, on partnership income, on donation to minors, reciprocal donation to minors, contingent donations, revocable donations. I want you to develop a character or strategy where you actually have to go and read the act. It's difficult to read the act, but as you read, you see that it's actually interesting. So you go to Section 10, you read subsection 1 to say what do they mean by that reinvestment income is deemed to have accrued to someone or to a taxpayer or to a person. What about partnership income? What about donation income? What are they really saying? But in this slides, we're just going to browse through to just give you an overview of what is happening. So by reinvestment income, we're saying it is taken as if you have received income that has been reinvested, capitalized, or accumulated, or on your behalf by others. So let's say I'm employed by EY. EY, instead of giving me my salary, then it actually transferred the salary directly to my investment account. So I have actually received the salary actually accrued to me, but I ended up reinvesting the salary. Then that one salary is deemed to have accrued to me even though I have reinvested it. Therefore, it is taxable. I am taxed on that salary. Okay. Partnership income, we said partnership is not a person, so it is deemed to have, the partnership income is deemed to have accrued to the partnership in their profit sharing ratio. Donation to minors, we're going to cover that. Residual donations, let's just cover it. Donation to minors, we are saying when a parent donates an asset to his minor children, and as a result of the donation income accrued to the minor, then such income is taxed in the hands of the parent. Because why? Because the Zimra cannot come and tax the minor, but rather if income is accruing to the minor, it is deemed to be accruing to the parent. So it is the parent who will be taxed on this one. Okay. Then reciprocal donations, when one parent donates to another parent's child, minor child, who in turn reciprocates with another donation to that parent's minor children, then both parents shall be taxed on income accruing to their own children. That is, the children's income will be taxed in the hands of his own parents. Okay, so this is reciprocal donations. Parent A donates to parent B's child. Parent B donates to parent A's child. That is a reciprocal donation. So parent A is taxed upon the income which accrues as a result of the donation by parent B, and so forth. Okay, deemed source, we normally want to examine on dividends, the foreign dividends. Foreign dividends, we say the source of dividends is where the share register is kept. So let's say you invested in a company that is in UK. So that's where the dividends are coming from. You received 100,000 as dividends. Is Zimra going to actually tax you? Yes, Zimra will tax you because they are deemed to be from a source within Zimbabwe, those dividends. So the deeming provision, the deeming source provisions applies on contract concluded in Zimbabwe for the sale of goods by a business person, income from trade services rendered outside Zimbabwe by Zimbabwean trader, income for employment services rendered outside Zimbabwe during temporal absences, income and of government employees working outside Zimbabwe, like those that are working on embassies. Then pension annuity from service rendered to Zimbabwe government, and foreign interest and foreign dividends. Number 6 is very important and highly examinable. So today we end here. We shall continue with section 12, deemed source, in our next lecture.